Let's get ready to mortgage. He is the prince of programs, guru of guidelines, master of matrices. He puts the fun in funding. Please welcome Mark, Mr. Mortgage, I Tell.
All right, my name is Mark Eitel, and you are listening to the Mr. Mortgage Show. And friends, you're in the right place if you've got questions regarding real estate. And who doesn't, right? Crazy headlines this week. Lots of news, Federal Reserve, interest rate hikes. Where are we going from here? Inflation, all of that is kind of swirling around in the headlines this week. But simmer down. You're in the right place if you want the data, the tips, the tricks, the strategies, the answers to your questions, and all the info that you need so you can make better real estate and mortgage decisions for you and your family. And man, oh man, we've got a great show lined up for you this week. We're going to dive into the Federal Reserve's comments regarding interest rates and inflation. And of course, we're going to take all your questions. I love your questions. They're my favorite part of the show. But if you want your questions or comments on the air, just call or text 855-462-7292. That's 855-462-7292. That is the Anytime Hotline. Jen, my producer, is standing by, womanning that hotline, and she'll get you on the air. If you prefer to send us an email, you can do that by visiting MrMortgageRadio.com. That's MrMortgageRadio.com. Scroll to the bottom of the page. On the bottom of the page, you'll find an email icon. If you click that icon, you can shoot your questions over that way too. Again, it's MrMortgageRadio.com. But hey, let's dive right in. The Federal Reserve Chair, Jerome Powell, testified before Congress. And guys, it was super interesting. I don't know how many people other than me geek out on this stuff, but anything regarding interest rates, economic news, specifically tied to housing, I am always all over it. But I found it interesting because the left of the left and the right of the right came at him with the same questions and the same fundamental concerns with where everything's going economically in this country and what these rate hikes stand to do to, one, unemployment, but also to a recession. And guys, I don't know about you, but we have so rarely agreed on both sides of the aisle on any one thing in such a long time that when you see everybody come together with the same mindset, you kind of sit up a little straighter and pay a little closer attention, because fundamentally there's something going on that everybody needs to be aware of. So I found it super interesting. I mean, clearly the Fed has indicated they are going to continue to raise rates until inflation gets down to that target 2% rate. And, you know, right now it's reported in the mid sixes, and is it really in the mid sixes, or is that artificially low or being manipulated because they don't want to scare us? So, and guys, I'm not for everybody always knowing everything. I do think there is some value in dripping information, because people have a tendency to overreact, especially when they don't understand things. But I guess where I'm going with all of this, is the spirit of that information that was released on Tuesday and Wednesday basically said, inflation is here. It's sticky. We have not gotten it under control yet. This is the Federal Reserve speaking, and we are going to continue to raise interest rates and may even raise at higher increments again. A half a point or 50 basis points moving forward. So all of that is interesting, because there were several people at the beginning of the year that were saying interest rates are going to fall again this year. And guys, if you've listened to the show for any amount of time, you know I don't believe that. And I think fundamentally, to understand that, we need to know how they got as low as they were and why that happened. And I'm not going to turn this into a long dissertation, guys. There's a ton of posts on all of our social channels where I dive deep on the mortgage-backed securities. But basically, when a lender lends money, they securitize all of those mortgage loans in a pool, and they sell mortgage-backed securities, much like bonds. They operate just like a bond. And they do that to recapitalize so they can loan more money. That cost of recapitalization is determined by the open market, the mortgage-backed security market. It's, just like stocks, bid and buy. When that costs more money in the form of interest, they have to charge a higher interest rate. Well, in the world of the MBS, the mortgage-backed security market, the lower the price for that security, the higher the yield, or the higher the interest rate. So when prices go down, yields go up. Well, supply and demand, guys, controls everything. I always talk about it regarding housing, but it also controls the value of mortgage-backed securities. Now, here's the interesting thing. During COVID, the Federal Reserve was the largest buyer of mortgage-backed securities. They were flooding capital into the market to keep the economy going. And you can argue they did too much or too fast, but none of that matters. It doesn't matter how it happened, why it happened. It matters that it did happen, and we're reacting to it right now. They had to do something. They couldn't just shut the door on the economy. They definitely had to put capital into the economy, or we would have been in a depression. But nonetheless, they were the largest buyer of mortgage-backed securities. Now they're not buying mortgage-backed securities. They are actually reducing the mortgage-backed security carry on their balance sheet, which is causing prices to go down because there's less demand. There's more supply and then demand, so the prices go down. In this case, the yields, right, or the interest rates go up. Well, they have no intent of being the largest buyer of mortgage-backed securities. As a matter of fact, in 2008, they were buying no mortgage-backed securities. So just a juxtaposition of where we are economically in this housing boom compared to 2008. So I share all of that because until there is a flood of demand in the mortgage-backed security market, which is traditionally foreign investors as well as institutional money, retirement funds and things of that nature here in the U.S., until there's a flood of demand, there's nothing to push those yields down. So guys, interest rates aren't going back to the 2s or 3s or even the 4s anytime soon. And we've said that for a long time. And the reason I'm sharing all of this is because still today, right now today, there are still strategies to get great interest rates. And the higher interest rate environment is also putting pressure on supply because the vast majority of mortgages were originated during 2020, 2021, and 2 when rates were low. So those people don't want to sell. And if you're sitting at home right now with one of those super low interest rates, I know you agree with me. People don't want to sell their house right now because they have a low interest rate. So because of that, there's less supply coming to the market. And again, supply and demand, just as we talked about it with mortgage-backed securities, then the cost of recapitalization, which determines the cost of a mortgage interest rate, the supply and demand also is at work in real estate. And until more people want to sell than want to buy, prices aren't going to go significantly lower for a long period of time. So I'm sharing all of that because the silver lining in all of the craziness going on is, yes, money is going to cost more. Yes, there's more pressure that's going to be put on the economy by the Federal Reserve. And yes, you definitely need to mind your financial home more stringently than in the past. You gotta watch what you're doing now more than ever, because it's likely that there's some pressures economically coming. But if you're a homeowner or you're thinking of becoming a homeowner, the silver lining in all of this is these higher mortgage interest rates are putting pressure on the supply side of the market, which is what is buoying home value. So I hope that makes sense. I hope that doesn't scare anybody. I hope it sparks some questions. If you've got questions and you want to get them on the air, please give us a shout. I'm looking forward to answering your questions and engaging in some interesting conversation. But guys, you hear the music, you know what that means. That is my cue. We'll be back in a few. Sit tight on the other side of this short commercial break. We'll be back with more of the Mr. Mortgage Show, and we're going to dive into those questions. We'll be right back.
Welcome back to the Mr. Mortgage Show. Call us now at 855-462-7292.
All right, we are back. My name is Mark Eitel, and you are listening to the Mr. Mortgage Show. And friends, we are so excited that you're with us today. We're going to dive into all of your questions here in a minute. And guys, if you've got questions or comments, you can call or text 855-462-7292. That's 855-462-7292. That is the Anytime Hotline. Jen, my producer, is standing by, womanning the hotline, and she will get your questions on the air. Again, if you prefer to do that via email, just visit MrMortgageRadio.com. MrMortgageRadio.com. Scroll to the bottom of the page, click on that email icon and you can shoot your questions to Jen via email. She'll get you on the air that way too. Hey, but speaking of Jen, my producer, she is always adding a little bit of sunshine and a smile to the studio. I want to check in with her. Hey, Jen, how are you? How was your week?
I had an awesome week. I hear you had an awesome week too. Do you want to let us in on that?
Yeah, I guess we might as well let everybody in on the exciting news. So if you've been listening to the show for any amount of time, you probably know, or if you've been watching us on social, that we have been transitioning to become part of a national team. So that transition is now complete, and we can help everybody in all 50 states. Well, that's not true. Everywhere but New York. Sorry, Big Apple. Nothing against you, but right now it is anywhere in the country except New York. If you've got mortgage needs, please reach out. We would be happy and honored to be part of your journey. So, yeah, Jen, thanks for throwing that out there. I've been holding that back until everything was complete, but I'm super excited about that. We've got the team spread out nationwide now, and we have already started to help some people all over the place, and super excited. Anyway, I don't want to turn it into an infomercial, but we're very, very excited about that. And that, coupled with the Really Great Agent Network, that is one of our sponsors, we are super proud to be part of that. We can get you in touch with a really great agent in your area also if you don't have that relationship already. So check out reallyGreatAgents.com if you're looking for an agent, or MrMortgageRadio.com if you're looking for some money. Hopefully we can help you. But anyway, again, Jen, thanks for throwing that out there. And guys, I went off on a bit of a tangent during that opening of the show about where interest rates came from, why they were that low, and why it's super unlikely that they're going to get back down there anytime soon, despite all the headlines, right? We know at the end of last year, there were many people saying rates are going to fall back into the fours by the end of the year. And guys, they're not going back down to four anytime soon. If you missed the opening segment and you want to listen to that diatribe, go to MrMortgageRadio.com and click on that top link. In a day or two, it'll be up as a podcast episode and you'll be able to hear it. But I hope that made sense to you. If you've got questions about that, please reach out, shoot us a text, give us a call, and I'll be happy to dive deep with you on that. And there is a silver lining in all of this, and it's interesting because the higher interest rate environment that we're in, historically, it's not high. It's higher than it was, and the recency bias makes it feel high because we just came out of an environment of the 2s and 3s, but historically, it's not a high interest rate. But nonetheless, the higher rate environment is prohibiting some people from selling their home, which again is putting more pressure on the supply side, which means at the moment demand is outpacing supply by historical standards, and prices are kind of digging in their heels and holding their value. Yes, appreciation has slowed, but we're going to talk a little bit about that too, because appreciation, interest rate, and sales price are not the most important numbers in the decision-making process with buying a home. And we're going to dive into that here in a minute. But before we do that, I do want to jump into some of your questions. So I'm going to throw it over to Jen for the first question of the day. Hey, Jen, do you have one? Okay, what do you have?
Bradley sent this one. Can you explain how the bank statement loan works? Do I take an average balance as income? I'm a contractor and have been in business for almost 4 years.
Hey, Bradley, thanks for that question, my man. And that is a great question. So it's super confusing because you hear that, and it's not the average balance, it's your deposits, right? So they look at either 12 or 24 months, depending on the program, depending on your credit score, of your bank statements, and then average your deposits over that period of time. But here's the caveat. Each industry has a different factor applied to those deposits. And you mentioned you were a contractor. Most contractors have material costs, some labor costs, even some interest carry costs if you're borrowing money to go buy those materials. So there is a higher cost to you of doing business than, say, somebody who is an accountant or a consultant. There's less of every dollar spent on overhead. So depending on your profession, you might get credit for a larger percentage of those deposits. But how it works, to answer your question, either 12 or 24 months worth of the bank statements, the deposits are averaged, and then a factor is applied to that number to determine what can be used as income. And then that's it. They're looking at your credit. They're using the bank statements to determine income, and then whatever your asset position is, because you will need to have enough money for the down payment, the closing costs, and then oftentimes 3, 6, or 12 months worth of cash reserves in the bank is what they're looking for. So Bradley, that, my man, is a great question. I appreciate it. I hope that answer helps. And the bank statement program is an amazing opportunity for somebody self-employed who, for whatever reason, a brilliant accountant or a lot of cash coming through the business, but you just don't show that money on your tax returns. And I always encourage everybody, before you go the bank statement route, to look into the full document process with tax returns, because oftentimes the underwriting process can add back in certain expenses, depreciation, things that are just paper deductions, if you will, not actually hard costs, can get added back into your income during underwriting. So oftentimes somebody who's CPA really beats their income up with all of the deductions. And guys, definitely take all the deductions entitled to you. Nobody should pay more taxes than they have to. But oftentimes there's enough add backs in the underwriting review that will allow you to qualify full doc. And then if you don't, there is always that bank statement program to fall back on. So again, Bradley, I appreciate that question, my man. But guys, you hear the music. You know what that means. That is my cue. We'll be back in a few. Sit tight on the other side of this short commercial break. We're going to be back with more of the show. Hey, it's Mark Eitel, host of the Mr. Mortgage Show, and I'm going to interrupt this commercial break to ask you for a favor. If you have any friends or family or coworkers who are thinking of buying or selling or refinancing real estate, I'm hoping I can count on you to introduce them to me, to the team, to the show. We'd love to help them any way we can. Just simply share the link, MrMortgageRadio.com, MrMortgageRadio.com. Again, it's Mark Eitel, NMLS 1929005. Now, back to the commercials.
Welcome back to the Mr. Mortgage Show. Call us now at 855-462-7292.
All right, we are back. My name is Mark Eitel, and you heard the man, 855-462-7292. That's 855-462-7292. That is the Anytime Hotline, and Jen is standing by, womanning that hotline, and she'll get your questions on the air. You can call or text that number, guys. Don't forget, if you're shy, you can shoot us a text. And the vast majority of people prefer text. I guess it's just the modern age that we're in. Or MrMortgageRadio.com, MrMortgageRadio.com. Scroll to the bottom of the page, click on that email icon, and you will be able to shoot us your questions via email too. So speaking of your questions, Jen, do we have more questions?
We've got questions, and they want answers.
All right. Well, let's keep it going.
Susan sent this text. Can I use my equity line as a down payment to buy a rental property? I have money in my 401k, but don't want to move it.
Hey, Susan, that is a brilliant question. And you can absolutely use your equity line as a down payment to buy an investment property. So just know that if you're going full doc and you're using your income to qualify for the property solely, then that equity line payment's going to be factored into your debt to income ratio. But if you're using the landlord loan that we talk about so often, we're just looking at the rental income from the property. And if that rental income supports the debt on the investment property purchase, you're home free. So you definitely have options. And to answer your question, yes, indeed, you can use your equity line. So I appreciate that one. Hopefully that helps. If you need more info, you know how to reach us. But hey, Jen, can you shoot me one more question?
Jonathan is asking, can I use an FHA loan to buy my house for my landlord? It's not a rent to own, but he's going to sell and willing to give me a chance to buy it.
Hey, that's a great question, Jonathan. Appreciate that one. Yes, you can use an FHA loan in that scenario. It's going to be important that your name is on the lease or that we can prove that that's your residence. Here's why that's important, because there's a different down payment requirement if that's not your residence in this scenario, if you can't prove that you currently occupy it. And I want to share an interesting story with you. We had a circumstance where a young woman, was buying a property in the exact scenario. Landlord wanted to sell. She had been renting for a few years. I think it was just over 2 years. And she was ready to buy. Perfect house. The math worked out. Her mortgage payment was just a little less than $100 under the current rent payment. So everything lined up. But here's the thing that almost got us wrapped around the axle. The lease was not in her name. Her parents leased that property for her as her very first property, and they put it in their name just to make the landlord feel good. The young woman wasn't going on the lease by herself. But here's the thing, they never put her on the lease at all, which in hindsight made all of this a challenge, because every form of identification and every piece of mail that she received still had her former address, which happened to be her parents' house. Now, in this story, there was nothing nefarious going on. She just lived a couple streets over from her folks, and it was easier for her to have her parents look after everything. So it was super difficult for us to prove that was her residence. So guys, here's how we did it. It was super interesting, but we used the shipment history from her Amazon account showing that she received mail there. And it wasn't a once in a while thing. She had regular shipments. So we kind of had to stretch our brains creatively to show that that was indeed her residence and had been for some time. And we were able to make it work. But wow, that was an interesting one. So didn't mean to go long-winded on that, but I do like to throw that out there because that is one of the caveats. Hopefully you found that interesting, and hopefully it helped as well. If you need more info, you can always reach out. I'm always happy to help. But hey, Jen, do we have another question?
Dawn sent this one. I have 2 questions. How does a construction mortgage work? Do we make the payments on the entire amount from the beginning, or do they increase as we go? Second question, how do we reach you to start the application process? We are in South Carolina.
Hey, Dawn, thanks for that question. I really appreciate that. And I'm going to start by answering the second one. You know how to contact us, 855-462-7292. When we're not in the studio, that pushes to my office. Or go to mrmortgageradio.com if you are ready to go right now. There's a new applicant start here box. Just click on that and it'll walk you through the application process. But that is a fantastic question. The construction loan is a very misunderstood animal. First of all, you pay interest only during the construction phase, and often you can have up to 12 months to complete construction of the house. Now, the interest due on the balance is only on the balance that's been used. So in a typical construction process, there'll be 5 or 6 draws. When the ground is prepped and the slab is formed and poured and the foundation is there, that's typically a draw period. And then they'll put the walls up and pour the tie beam, and maybe they'll dry in the roof. Now that's a shell. That's another draw period. So that balance is going up. You've pulled some of that money that was available for construction down. You've paid the contractors, and now you're servicing that debt interest only during that period of time. But here's the cool thing about a construction loan. That interest is built into the loan so that you don't have to make a payment until you close and move into the property and it converts to a mortgage. So you'll hear the term construction perm, which means that it's a 2-part loan. What happens is during the construction period, it's like a credit line, an interest-only credit line, and the interest reserve, there's an amount of money built into the loan reserved for paying the interest during that construction period. So to answer your question, as long as it gets finished on time, you don't have to pay anything. The loan is paying for itself in the beginning. Once the property is finished, you got your final inspection, CO is issued, you are ready to move in, then that converts to a permanent loan or a fixed rate mortgage, 15-year, 30-year, whatever mortgage product was attached to it in the beginning. So construction perm, the perm is the conversion, and it becomes the mortgage at that point, and that's when payments are due. But brilliant question. I hope that helps. If you need any more information, because I know it's super confusing, we are always standing by and happy to help. And yes, we can help you in South Carolina. If you heard the opening segment, we can now help you just about anywhere, and we're super excited about that. But Dawn, thanks for that question. That was a great one. You hear the music, guys? You know what that means? That's my cue. We'll be back in a few. Sit tight. On the other side of this commercial break, we're going to be back to take more of your questions. Let me tell you a little story about a man named Jed. Well, actually, this is a story about Mary, not Jed. Mary is an awesome single mom who's been raising her daughter in the same one-bedroom apartment for the last 11 years. That's right, one bedroom. They've got bunk beds in there, and they've made the best of it. Her daughter's now a teenager, getting ready to start high school. The bedroom is a challenge, but more importantly, sharing that one bath is getting tough. So she decided to take the plunge and become a homeowner. We got her approved with an FHA loan. That's right, I said it, FHA loan. If your agent's telling you that FHA or VA loans are not being accepted right now, you're talking to the wrong agent. Give me a call and I'll get you in touch with a really great agent. Back to the story. She took the plunge and she is now the proud homeowner. They each have their own bedroom and, more importantly, their own bathroom. Super excited for Mary and her daughter. If you want to learn more, check us out online at MrMortgageRadio.com. That's MrMortgageRadio.com. Or call us at 855-462-7292. My name is Mark Eitel, NMLS 1929005.
Welcome back to the Mr. Mortgage Show. Call us now at 855-462-7292.
All right, we are back. My name is Mark Eitel, and you are listening to the Mr. Mortgage Show. And guys, you're in the right place if you want the data, not the crazy headlines, but the real data, the tips, the tricks, the strategies, the answers to your questions, the information that you need so you can make better real estate and mortgage decisions for you and your family. Again, my name is Mark Eitel. This is the Mr. Mortgage Show, and we do this each week right here. Same bat time, same bat station. And Jen, my producer, is womanning the Anytime hotline. She'll get your questions on the air, and you can shoot those over to us via text if you prefer, or give us a phone call. Either one will work on the Anytime hotline, 855-462-7292. That's 855-462-7292. Or shoot us an email, and you can do that by visiting Mr. Mortgage Radio. That's MrMortgageRadio.com. Scroll all the way to the bottom of the page, click that email icon, and shoot us your questions that way. But speaking of Jen, speaking of your questions, I know we've got some stacked up over there, so let me throw it over to Jen for another question. Hey, Jen, you ready?
Carla wants to know, are there any no-income verification loans for buying a second home or an Airbnb?
Hey, Carla, that's a great question. On the second home piece, it's a little more of a challenge with the no income verification, but the Airbnb is going to be treated like an investment property. So if you're going to buy this second home with the intent to Airbnb it when you're not there, then this would also apply. And I'm kind of reading between the lines based on your question and based on what we're seeing in the market. A lot of people are doing that. A lot of people are buying that second home in the awesome location, amazing view, and that's a great place to vacation. But when they're not there, they're using that Airbnb strategy to generate positive cash flow. So if that's the scenario, this will work by using the landlord loan. And that landlord loan takes the rental income either with a normal rental environment where someone's signing a 1-year lease, or Airbnb rental works also. And the income generated from the property is what's used to service the debt. So as long as it's generating enough income to pay the mortgage, then we don't even need to look at your personal income. We look at your credit, we look at your assets, and then we look at the income produced from the rental property. And that is called the landlord loan. And I would be happy to discuss that further with you. But to answer your question, absolutely, yes, that would work as a no-income verification strategy as long as the rent from the property pays for the mortgage. So great question. And again, guys, we're seeing a lot of that right now where people are using their second home properties to generate income with Airbnb. So I appreciate that one. Hey, Jen, do we have another question?
Megan sent this one. We are considering a debt consolidation refinance or an equity line. Currently, we have a great interest rate and don't want to lose it. but our credit cards and car payments are high, and we're nervous about my husband's job. I'm not sure the best way to go. Do you have any advice?
Hey, Megan, this is a tough one. Great question. 3Gs, the 3G question of the day. But here's the thing. The equity line is the easy answer, right? Because you don't have to disturb that first mortgage interest rate. Well, here's the thing. With the equity lines, if the market tightened, and we're already seeing it in some markets where the banks were going to the 90% of the value with the equity line. Now they've pulled back to 80. They could pull back more. If property values decline in some markets, then that equity may not be available. So what happened in the early 2000s during the downturn in values in the overall recession period that we were in, the housing crash, if you will, a lot of banks closed the equity lines or reduced them greatly. So if you're going to use that capital immediately and you're not just going to open the equity line and just park it and hope that, bad things never come and you don't need it, then the equity line is absolutely the way to go because you don't need to disturb the current first mortgage interest rate. But here's the thing, whatever you're going to do, I would encourage you to do it before the hardship comes. So once your husband loses his job, you're most likely not going to be able to qualify, right? Because now it's one income or maybe no income. Maybe he's the sole earner. I don't know. But my point is, oftentimes we wait too long before we react to a circumstance. Now, if you're thinking he's going to lose his job, guys, we heard from the Federal Reserve this week, more interest rate hikes are coming. So your credit card payments are going to go up. And if you're already struggling with those, I would encourage you to do something now before that hardship is in existence and you might not qualify for either the equity line or the cash out. Now, to answer your question, pros and cons of each. The pros of the equity line are you keep your first mortgage in place. The cons to both of them are that you're using your equity. The cons of the equity line are it can be reduced in the future. If you max it out, they're not going to ask for the money back. But if you've got an available balance, they might reduce or close the equity line. We saw that happen. And then the equity line payment is going to go up with the interest rate hikes because that's adjustable rate debt, just like a credit card. It adjusts every time the Federal Reserve increases interest rates. That overnight rate affects prime, and then whatever the increments are adjustment with an equity line, most often it's monthly, you're going to see an increase in the cost of that money. And a lot of people are surprised right now that equity lines aren't the cheapest option on the street because of what's happened in the interest rate environment over the last, 18 months. So the cons of the equity line are the interest rate is going to go up based on what the Federal Reserve said. So payments are going to go up. It could be reduced or closed if the market changes in the future, if something affects your equity position or their underwriting guidelines. The cash out refi strategy is the obvious con is that you're refinancing that low first mortgage at a higher interest rate. In most cases. And based on your question, I'm assuming that's the case with you as well, because you don't want to affect that first mortgage rate. So that being said, that's the number one con there. Also, too, versus the equity line, you're extending that debt for, say, 30 years if you do a cash out refi with a 30-year fixed rate mortgage. The upside to it is that it's one fixed payment over a long period of time. And most of the people who find themselves in a debt challenge benefit from that one low fixed payment. So whatever you do, I encourage you to do it before you need the money, if that makes sense, right? You pack a parachute before you get on the plane, because if your husband loses his job or these rate hikes continue to affect your credit card payments and you're in a position where you miss a credit card payment and now you've got a credit score reduction, or your husband loses his job and now you have an income reduction, it's most likely going to affect your ability to qualify for either. So this one may require a deeper conversation. And if you want to have it off the air, I welcome the opportunity. No judgment at all. We have all been in this position at some time during our lives. And if you want to swap some horror stories, I'll share what I went through during the housing crash of the early 2000s. But great question. I'm sorry that you're in this. The good news is it sounds like you have some equity, and well managed, you'll probably find your way out of it. But I appreciate that question. And guys, I throw that out there to anybody. If you're in a position where you think you're going to need the money in the future, don't wait until you need it if you're going to be unable to qualify for it at that point. What I mean is a job loss, or you're going to miss a credit card payment, or you're going to miss a car payment, and that's going to negatively impact your credit. I've seen too many people wait too long, and they're in a bad position. So if anybody wants to dive deeper on that, shoot me some more questions, or if you want to have a confidential conversation, I always welcome the opportunity to talk more about that. So that was a great one. Hey guys, you hear the music? You know what that means? That is my cue. I need to stop talking and bounce into this quick break. On the other side of this break, we are going to be back with more of your questions and more of the Mr. Mortgage Show. Sit tight. We'll be right back. Hey, it's Mark Eitel, host of the Mr. Mortgage Show, and I'm going to interrupt this commercial break to ask you for a favor. If you have any friends or family or coworkers who are thinking of buying or selling or refinancing real estate, I'm hoping I can count on you to introduce them to me, to the team, to the show. We'd love to help them any way we can. Just simply share the link, MrMortgageRadio.com, MrMortgageRadio.com. Again, it's Mark Eitel, NMLS 1929005. Now, back to the commercials.
Welcome back to the Mr. Mortgage Show. Call us now at 855-462-7292.
All right, we are back. My name is Mark Eitel, and you are listening to the Mr. Mortgage Show. And you heard the man, 855-462-7292. That's 855-462-7292. That's how you get your questions on the air. You can call or text that number, 855-462-7292. Jen, my producer, is standing by, womanning that hotline, and she'll get you on the air. Again, if you prefer to do it via email, just go to MrMortgageRadio.com. That's MrMortgageRadio.com. Scroll to the bottom of the page, click that email icon, and you can shoot us over your questions via email. But guys, we've had some amazing questions so far today. I hope everybody is having fun. I know we've got a few more questions lined up, and I'm going to do my best to get through all of them. So let's keep them coming. Hey, Jen, do you have another one ready?
Terry has this question. Is it possible to refinance a house that's currently in foreclosure? We do not have an auction date yet, but it's getting close. We have lots of equity, if that helps.
Hey, Terry. Wow, that's a great question. So usually the answer to that question is no. And here's why. So it sounds like this late in the game, your only real option may be a private investor, right? You hear the term hard money, and you can get a hard money loan on a property that's in foreclosure, assuming several things. One is that you've got a ton of equity. Two is that it's not your primary residence, because if you've filed homestead exemption on a primary residence, there are protections granted to the homesteaded property, which make the foreclosure process longer and more expensive. And if you are already up against a pending auction date, it might make sense at this late stage just to sell the property. You mentioned you had a ton of equity. You could sell the property, and you might find a private investor to buy the property and do a lease back, but you might be in the position where you just sell the property, take that equity, and then start over somewhere scratch with some money in your pocket. I wish there was a better answer for you, or I guess, let me rephrase that. I wish there was an answer that you wanted to hear more than that one, but that might be the reality of the situation. And I encourage you, don't wait too long. If you wait too long, someone may try to take advantage of the situation and not give you the full value of the property. If you've got time to pull this off, there's still a ton of demand in the market, and it might make sense to sell it. But hey, if you're open to a conversation, give me a call off the air and we can talk. I can use the Really Great Agents Network and contact an agent in your area. You don't have to talk to them, and I can get a market analysis from a timeline standpoint. I can do the value report for you, but we can get some data on how quick properties are selling and if there's an appetite for your property to see if that might be an option for you. But I appreciate that question. Thank you so much for it. And again, we're here if you need us. So, hey, Jen, do we have another question?
Cynthia sent us this one. My goal is to buy a house this year. I'm hoping rates and prices come down a little, but what are a few things I should focus on to get myself ready? I've got decent credit and a good job.
All right.
That's a start.
That is a start. Hey, Cynthia, thanks for reaching out to us and congratulations on jumping in. And what a brilliant question. You know, the pre-planning, if you will. So what I tell everybody who is in this circumstance is to live as if you already own that property. So do your budget and what is the monthly payment going to be on the new property? And let's assume for a minute that it's a move up. Let's assume for a minute that the mortgage payment is going to be more than your current rent, which often is the case with a first-time buyer because you might be renting below your means so you can save up that down payment, which is a brilliant strategy. So if you're paying $1,500 a month for rent and your mortgage payment on the new property is going to be $2,000, well, start spending $2,000 a month on rent, but put that $500 in your savings account. So you're living as if you already have that expenditure of the mortgage payment. So that would be my very first piece of advice. My second piece of advice would be do not buy anything. Don't buy a new car. Don't take out any new credit cards. Don't finance the, entertainment center at the furniture store. Preserve your credit, if you will. Don't do anything that is going to put more debt on your balance sheet, and do not do anything that's going to jeopardize your current credit score. So live as if, and then just do not finance anything. And if you're up against a lease and you're going to go buy a new car, I get that, but keep the payment at or below where you currently are. So don't stack any new debt on your credit and live as if you are already in that new house. And that would be my two biggest suggestions. And then watch your credit score. Use a free service like Credit Karma, but watch your credit score. So if there are any changes, anything reported in error, make sure that you can address that now early on, and we can help you through that if you need any advice on that. So brilliant question. Congratulations. And wow, what a great job being proactive. So we're here if you need us, or we're here when you need us. And I'll be happy to be part of that journey with you. But thank you so much for that question. Hey, Jen, what else do we have?
Ruth and Jim are asking, we listened to your talk on reverse mortgages. I think you said we can use a reverse mortgage to buy a home. Is this correct? Can you explain this? Thank you.
Hey, that is a fantastic question. I'm going to pull the 3G question from earlier in the show, great, and give it to you because that's actually, you know what? They earned the 3G question, so I'm going to make you the 4G question. Great question. So I almost need a whole episode to explain this. So what I'm going to do is give you an example, and in that example, I think you'll find the answer. I've got a client whose property is worth $500,000. And I've used this example before because it's a real example. And they want to move into the new 55 plus neighborhood with all the cool amenities, pickleball, the bus to the Whole Foods grocery, all the cool stuff. To get into that neighborhood is also $500,000, but they're on a fixed income and they don't want to sell the property, put a down payment down, have the burden of a big mortgage payment as well as taxes. And there's an association in the new neighborhood. So reverse mortgage for purchase comes marching in. And here's how it works. They sell that house for $500,000, their current property, which is an awesome house in an awesome neighborhood. The neighborhood no longer meets their lifestyle needs. That's all. It's the house they raised the kids in. And now there's a bunch of young families in the neighborhood and they feel out of place and they want to be in that cool pickleball community that I just described. So they sell awesome house number one for $500,000. They put $250,000 in the bank. Now they have a cushion. They put $250,000 down on the new property. They put a reverse mortgage in place for the second half, the other $250,000, and they have no monthly mortgage payment. Now, they do have to pay their association, they do have to pay their taxes and their insurance, but they have that $250,000 in the bank as a cushion, as well as all of their other income from retirement, Social Security, disability, whatever the circumstances are. So that's how a reverse to purchase works. You have to put enough money down to meet the equity requirement for the reverse mortgage. And instead of it being a quote unquote refinance, a cash out refinance, which is how a traditional scenario for a reverse mortgage works, in this instance, that reverse goes right in place during the purchase, and you've put enough money down to meet that equity requirement. And I know the next question is, hey, Mark, what is the equity requirement? Well, that's going to be dictated on several factors, the largest one of which is your age. And it's the younger of the two of you if you're moving together. I'm assuming it's the both of you moving together. Sorry about that. So the younger of the two is the age used in factoring the down payment. So I'm happy to spend as much time as you need walking through that. I think that is a brilliant, brilliant question. I don't think it gets enough attention. I'm super proud to be certified in the reverse mortgage space. It's close to my heart. A reverse mortgage is not for everybody, guys. It is a tool, but used well, it can change your life significantly. So brilliant question. I hope that helps. I am always available to dive as deep as you would like on that. But guys, you hear the music? You know what that means? Man, oh man, we have wrapped up another week here at the Mr. Mortgage Show. Where does time go? I have way too much fun doing this. I hope you have fun spending some of your day with us. If you need us during the week, 855-462-7292, 855-462-7292, or check us out online at MrMortgageRadio.com. That's MrMortgageRadio.com. I was going to throw it over to Jen, but she's busy back there, so I'll say bye for her. Bye. That was a poor impression of Jen. But anyway, guys, we'll be back here next week. Same time, same station. Have an amazing week. We'll see you next time. Hey, it's Mark Eitel, host of the Mr. Mortgage Show, and I'm going to interrupt this commercial break to ask you for a favor. If you have any friends or family or coworkers who are thinking of buying or selling or refinancing real estate, I'm hoping I can count on you to introduce them to me, to the team, to the show. We'd love to help them any way we can. Just simply share the link, MrMortgageRadio.com, MrMortgageRadio.com. Again, it's Mark Eitel, NMLS 1929005. Now, back to the commercials.